Welcome to this analysis by Corporate Lab. Today, we're asking a billion-dollar question. Is Citigroup's turnaround actually gaining momentum? We're going to unpack their highly anticipated Q2 2026 earnings report to see if CEO Jane Fraser's massive multi-year structural overhaul is, finally taking hold. I'll walk you through exactly what the data shows and how I'm reading it.
But before we jump right into the numbers, just take a quick second to note the disclaimer on your screen.
Okay, here's our roadmap for this explainer. We'll hit the headline numbers, dive into the core revenue drivers, check the market's reaction, look at the bear case, and finally wrap up with what to watch next. Let's kick things off with Section 1, the headline numbers. A seminal milestone for the new Citi.
Now, to really grasp these numbers, we have to remember the broader context here. Citi has been attempting a monumental pivot. They're transitioning away from this whole era of intensive remediation and major divestitures, right? They're moving toward a capital-light, high-return growth phase under what they call the One Citi model. And looking at the data, it honestly looks like the bank is finally shedding some of that legacy weight.
And man, the upside surprise here is huge. Wall Street consensus had earnings per share pegged at $2.64. But the actuals? They came in at $3.15. That absolutely crushes expectations. It's a clear signal that some serious operational leverage is finally starting to flow right down to the bottom line.
So what does that EPS beat actually look like? Well, it translates directly into a massive $5.8 billion in net income. If you look back at the $4 billion they posted in the exact same quarter last year, wow, that is a staggering 45% year-over-year surge. That's the kind of fundamental, undeniable profitability leap that institutional analysts just can't ignore.
But it's not just about pure income, right? The underlying structural metrics are practically a wish list for the bulls. Return on tangible common equity, which is obviously a critical measure of profitability, jumped to 13.0%. That's up 430 basis points year over year. Total revenues hit a very healthy $24.8 billion, a 14% increase. The CET1 capital ratio is sitting rock solid at 12.8%. Oh, and check this out. Tangible book value per share officially crossed the $100 mark, up 7% to $100.89.
All right, moving right along to Section 2, core revenue drivers, decoding the engine of growth.
The absolute standout takeaway here is the synchronized double-digit growth across Citi's core businesses. It's really firing on all cylinders. Services brought in $6.4 billion, really acting as the crown jewel of the operation by clearing trillions for global multinationals, and that's up 18%. Markets crossed the $7 billion mark, heavily driven by this massive 45% surge in equities trading. Wealth grew 13% to $3.17 billion too. So this isn't just one lucky segment carrying the team, it's a broad-based expansion. And it gets better because we're actually seeing positive operating leverage playing out in real time. Basically, revenue is growing faster than costs. Yes, higher compensation and heavy tech investments pushed operating expenses up 5% to $14.2 billion. But the 13% jump in net interest income, it easily outpaces that expense bump. The firm is simply generating more revenue for every single dollar it spends.
Now, what I find truly fascinating is the sheer velocity of their capital returns. Management returned around $5 billion to shareholders in this quarter alone. That equates to a 92% payout ratio, which is just massive, fueled by their $30 billion multi-year buyback program. Mathematically speaking, buying back stock at this kind of volume consistently shrinks the share count and effectively supercharges future per-share earnings.
Which brings us to Section 3, the market reaction, re-rating a turnaround narrative.
Obviously, analysts are taking note of all this. Ben Emmons, the CIO over at FedWatch Advisors, pointed out that Citigroup's turnaround is potentially being underestimated by the market. Think about it. With a PE ratio hovering around 13.5, which is surprisingly well below its 5-year average, bulls are arguing that this strict operational discipline and these massive earnings beats haven't even been fully priced into the stock yet.
If we look at the valuation models from Ticker, we see a mid-case target of $167.91. Now, this specific scenario assumes roughly a 4% annual revenue growth and net income margins stretching toward 21%. If Citi actually hits its stated 11 to 13% ROTCE targets by 2027 and 2028, those ongoing buybacks we just talked about could compound their per-share earnings in a really significant way over the next few years.
But let's flip the coin. Section 4, the bear case, frictions, risks, and skepticism.
Because critics and skeptics are definitely pointing out some real friction points. risk certainly hasn't vanished. For one, there was a $2.5 billion provision for credit losses this quarter, with net credit losses up 8% year-over-year. Skeptics are keeping a really close eye on rising consumer delinquencies and commercial real estate exposure. Plus, as a massive global bank, Citi naturally has some complex geopolitical exposures, like trade risks in China and tensions in the Middle East, alongside just general macroeconomic rate uncertainty.
And skeptics are asking a totally fair question here. Is this quarter just a high watermark? Was it driven by exceptional temporary trading conditions? I mean, it's perfectly reasonable to wonder if a 45% surge in equities and double-digit revenue growth is actually sustainable if market volatility suddenly drops, or if that investment banking pipeline starts to cool off.
So, where do we go from here? Section 5. What to watch next. The forward-looking checklist.
Rather than trying to gaze into a crystal ball and make forecasts, we're just going to watch the data. Here's the checklist. First, we need to track their progress toward that 11 to 13% ROTCE target. Second, the actual execution pace of that massive $30 billion share buyback program. Third, credit quality trends, specifically looking at non-accrual loans and consumer credit metrics. And fourth, the sustainability of mid-teens growth in their investment banking pipeline, right alongside that services and markets expansion. Ultimately, we want to see exactly how management balances aggressive capital returns with global expense discipline.
As we wrap up, I just want to clearly reiterate that this explainer is independent research and analysis for informational and educational purposes only. It is absolutely not investment advice. Thank you so much for joining me on this deep dive. So, with all this data laid out in front of you, what do you think? Is this just a lucky quarter fueled by a hot market, or is Jane Fraser's Citi finally ready to permanently shed its legacy discount? Let the data guide you and keep exploring.